Hello. So this video is talking about the multi-step income statement. And we're covering this topic because this is really important for merchandising companies knowing how to read and understand the multi-step income statement as well as preparing it. You'll see that based on the text, there's two types of income statements: the multi-step and the single step. The single step we would have gone over previously from module 1, where pretty much all they do is they put together all of the revenue, they add all the revenue up, and then they add all the expenses up, and they take the expenses away from the revenue to get net income or net loss. We should know that net income only happens when we have more revenues than we have expenses, and a net loss happens when we have more expenses than we have revenue. So that's a key point to note. The single step statement only separates revenues and expenses, whereas the multi-step income statement takes into consideration the details that go along with the types of expenses and what happens with the revenue. So with the multi-step income statement, what happens, and you should have seen it in the text when you would have read the chapter, they have actual steps that go into preparing the statement. So the first step, we would calculate what's called the gross margin. Then we would calculate income from operations, and then eventually we would get down to calculating the net income. There's more details about this in Learning Objective 2 in chapter 5 of the text. So make sure you're doing your reading along with everything that I'm presenting, because you're going to get the full picture with the reading and the documents and videos posted. With the multi-step income statement, you'll find that they have some new terminology that's involved. Whereas a single step was very basic, very simple, the multi-step now brings things into consideration like net sales, cost of goods sold, gross margin. All of these, you need to understand what they are so that you know how to calculate everything properly in the multi-step income statement. So this video, what we're going to do is go through how to translate the single step income statement into the multi-step income statement, similar to what we did for the balance sheet, where we had a simple balance sheet and we prepared a classified balance sheet as a result of just breaking out the different categories in the balance sheet. Just like that, we're going to look at the different categories and the different way of reporting on the multi-step income statement right now. And so it's worth mentioning, just as with the two balance sheets we prepared, with the two income statement, the end result is going to be the same. The net income is going to be the exact same amount by the time we're done with the multi-step income statement. All of the figures here, which would be the figures in this column, we would transfer over into the multi-step income statement. So it's all going to just look different, but it's going to portray the same information just in a different format. And this, like we said, from looking at the text, this format is going to help a manufacturing company to be able to identify the costs that are specifically related to preparing the product or purchasing the product that's being sold. And so that's the purpose for having the multi-step statement, because the categories and the different classifications are really helpful with that. So working on this multi-step income statement, what we'll see is the first thing we need to calculate, which I started to put some of them on the side here, is our gross margin. And what we saw, or what we should have seen in the book, in order to calculate your gross margin is a formula that is net sales minus our cost of goods sold. And so we're going to take that information and we're just going to plug it in to our multi-step income statement. of course, starting with our net sales. Now, net sales is a formula in and of itself, again, because every time you see net means that something was taken out of this balance. So because I see net sales, that suggests to me that something was deducted from sales to get to net sales. Similar to how that we have a gross margin, something was, well, nothing was taken out of the margin of the company, which is why it's gross. But as soon as something is taken out of it, then it's considered to be net margin. So there's gross and there's net. Gross means that there's nothing taken out of it to get to that number. Net means that there was something taken out of it to get to the figure that you have. And so that was just some nuggets there. With our net sales, if we look at the listing of our accounts, we'll see that the only thing that kind of fits in that formula is sales, because net sales equals to sales minus any sales returns and allowances. So what we can assume when it's like that is that there would have been no sales returns on allowances. If there was, I guarantee you it would have been specified in the income statement. Like I said, we're not adding any new accounts to this list. We're just taking the information from one side and putting it to the other side. So if we don't see any sales returns and allowances on this side, then that means there were none. And so what we can do is we can put that in there. We can show it. And one thing to note, if you look in the text, they actually name it gross sales, which would follow the same concept that we were talking about. Sales and gross sales are essentially the same thing. And so our gross sales would be the $50,000 that we have recorded. And just for clarity, we're going to put less sales returned on allowances. And as we said, there were no sales returns and allowances, so that's 0. And so our net sales then is the 50,000 minus 0, which gives us 50,000. So you kind of just put that there for putting it there sake, I guess. What I like to do is I like to indent things so that everything is orderly. So it's clear to see certain things. Like net sales is important, so I would probably put that in bold as well. So let's continue calculating our gross margin. We have our net sales figure minus our cost of goods sold. Now, do we have cost of goods sold here? Yes, we do. It's called cost of sales, but that's okay because generally it's the same concept. Cost of goods sold, cost of sales can be interchangeable, but we have to write it as it is written because this is the name of the account on the company's books. It's not cost of goods sold on this particular company's books. So therefore, when we bring it over, we need to put less cost of sales. The cost of sales amount we have is 15,000, and these are in the negative because it's just showing us that they're opposite of the revenue accounts. So how these revenue accounts are added together and these are taken away from the revenue. That's why it's shown as a negative. And so essentially let's do the same thing over here to make it clear that we're deducting from our net sales, and this gives us our gross margin. The gross margin is going to be 50,000, and I'm going to plus the 15. And of course, for anybody who's familiar with Excel, I had to put the plus in my formula because I already added the brackets, which shows up as a minus. So I don't need to add another minus again because it's going to calculate it incorrectly. So let me show you how that will come out. Because it's a double negative, it means add, and so therefore it wouldn't have calculated it correctly. So always pay attention when you're using your formulas to make sure that the formula is doing what it's supposed to be doing. Because as long as it's not, then that means we have to fix it. So I know that 50,000 minus 15,000 is not 65,000. So therefore I had to make that adjustment there. Okay, and so this is the first step in preparing the multi-step income statement, because we have arrived at our gross margin. So in this instance, the gross margin for the company is $35,000. Step 2 involves taking a look at the income from operations, which, let's put this here, income from operations, which is essentially just our gross margin minus our operating expenses. Let me do it so it all fits on this one page for you. So gross margin minus operating expenses is our income from operations. So we have to calculate this next, and all we do is continue to add it along. These statements should flow. It's not an actual calculation that you just put on the side. It's something that you show what is your gross margin, what are your operating expenses, and then you show the total gross margin minus operating expenses gets you the income from operations. So your statement should always flow from top to bottom. So for our income from operations, we would have already calculated the first portion of it, which is the gross margin. So there's nothing left to do for this part. All we need to do now is figure out what our operating expenses are and take that away from our gross margin. And so the proper setup for that is that we should make a heading for our operating expenses, and then we should list our operating expenses below. Now, operating expenses is also something that has a formula. And that formula is that you calculate operating expenses based on selling expenses plus general and administrative expenses. And do the same thing here. Merge and center wrap. There we go. So operating expenses equal to our selling expenses plus general and administrative expenses. And so that means here that we should put selling expenses and general and administrative expenses. Okay, change the format there, and I like to indent it just to make it look clean. Okay, so we need to know how to calculate this operating expenses based on these totals. Let's go into what some of these mean. Operating expenses tend to be anything that the company does outside of, any expense the company has outside of purchasing the product and preparing the product. Selling expenses are anything that the company, any expenses the company incurs in order to sell its products. So that could be a commission to a salesperson, could fall underneath selling expenses because it's directly related to selling the product. It could as well be advertising, any trucking or any vehicle that's being used to drive gas, I guess, to drive the vehicle to and from, drive the product to and from maybe a warehouse to a customer, things like that. Anything that is directly related to helping a product get to the end user or the customer can be considered selling expenses. General and administrative, on the other hand, are the costs that happen irregardless of how many products are sold or selling products at all. If you end up not being able to sell any products for the month, general and administrative expenses go on. So, general and administrative expenses could be rent, whether you sell products or not. A company normally has the same amount of rent to pay every month. Same thing with a person that's managing the office. If they're managing an office, they get paid a set salary regardless of how many items are sold. License fees is the same each month. That's normally general and administrative as well, just as well as things like cable and telephone expenses. Those type of things happen whether they can happen without anything going on, and therefore they're considered to be general and administrative expenses. And so companies in merchandising organizations usually separate these because it's important to know how much cost will actually happen regardless of how much I sell. And then it's important to know that how much cost did I incur just to sell these products. That's important to know. And so they do separate that in a multi-step income statement. So we will just take this information directly from our single step. Selling expenses were $5,000. General and administrative was also $5,000. And so that just means that my total operating expenses is equal to this plus this. Looking at it, I should know it's 10,000. And so I know that my formula is correct because my total operating expenses is $10,000. Now I can't just leave it there because I actually have to calculate this income from operations. And so that's the next thing I'm adding here. Income from operations. I'm going to bold it because this is also important. And then I'm just going to follow what the formula says. I have my gross margin, the 35,000, and then I have my total operating expenses, which is 10,000. And so that then means that my total income from operations will be 25,000, because 35 minus 10 is the 25,000. So that's the income from operations that I have thus far. What is worth mentioning, sometimes a company can have more operating expenses than they would have gross margin. And in instances like those, then it's not really income from operations, it'll be a loss from operation. So we only call it income because this is a positive number. If it was a negative number, then it would be a loss. And that's normally how it works with the income statement. Similar to net income. If this was a negative 3,200, then it would have been a net loss instead. So that information changes based on the profitability of the company, because we should know that only the income statement calculates profitability. Okay, so this is step 1 and this is step 2. So from step 2 we have to move on to getting closer to our net income, because you'll notice that there are still some other things over here that just were not included, and we should include that. We should include everything from our single step income statement onto the multi-step. So what are the next items that are added? Usually after income from operations, we have to add our other revenues and expenses. This is another category, and all this does is this includes any expenses that don't fit within selling or general and administrative expenses, or other revenues that don't fit within our regular sales. And so it's important to know that normally any revenue that occurs or any expense that occurs that's not a part of what the business normally does, they're accidental, or they are just some extra things that the business does to get additional money or has additional expense, they're considered to be other. They're not a part of the main business, and therefore they fall underneath other. And so what happens here is we just list those. We normally list the revenues at the top. The only revenue that's outside of the normal business is this interest revenue. Normally things like interests and things like that usually fall underneath other. And so we're going to add that as other revenue. And then we're going to have other expenses. Depending on how many revenues and how many expenses there are, we would treat it similar and add them together and then add them together again. But because there's only one revenue item, there's only one interest, there's only one other expense, we're going to just add that at the bottom here. Right. Now, let's take those amounts. We have the 200, and we have the interest expense of 2,000. And what we will note is that we have to add these together. So we have our total other revenue and expenses. Revenue and expenses, which would be the total of these two. Now, just as with the single step income statement, the revenue is one, does not have a negative sign in front of it, or it's not in brackets, and the expenses have a negative sign in brackets. So when we transfer it over, it has to do the same thing. So our interest revenue and our interest expense, we have to add them together, equals to this plus that, and we get a negative 1,800, which is correct. So that's just telling me that I have total revenues and expenses. My expenses outweigh my revenue in this instance, so that's why it's a negative. From here, and you could have actually put other revenue less interest expense as well. That would have been okay to use. And from here, what we calculate next will be our net income. Yes, it will be our net income. Actually, what you can do, because the book does have it differently, they have the excess of other expenses over other revenues, so you can do something like that as well, because I was just pointing out that expenses was greater than the revenue in this case. If that's okay, this is also fine, because that's not a main description, and therefore you don't have to be as specific with that description, but it's achieving the same objective. And so in this instance, now that we have all of that, we can calculate our net income. And our net income is a formula, which is income from operations, and it's going to be plus or minus other revenues and expenses. And we have the plus or minus because it can change depending on whether or not revenue is greater than expense. Because if revenue was greater than expense, then we wouldn't be taking it away, because we would have a positive figure here. And so because we have a negative figure, in this case, we're going to take away. And so let's calculate our net income, and let's see if it does match. We should have the 25,000 plus the 1,800, which gives me 22,200. And as with all accounting reports, we would use the double underline to signify that this is now complete, because the final step or the final balance in any income statement is always our net income. So this is where we get step 3, and this is step 4. Now, here is the question. Does my income statement balance? Does it agree to the previous side? Well, no, it doesn't. Because the single step is 3,200, whereas the multi-step that we have is 23,200 in net income. They don't agree, and that means that something went wrong in the process. So I kind of did it this way too, to help you to see that things can go wrong and how to get back on track. One way I could try to figure out what went wrong, if I have 32,000 minus 23,200, I have a difference of $20,000. So, first step in elimination, making sure that everything is calculated correctly. I know these are calculated correctly because we went over them very diligently, and they should be calculated correctly. Next is to make sure that the numbers I brought over are correct. So 50, 50, 50, 50, I have that 0. Cost of sales is 15,000. We have selling expenses 5,000, general admin 5,000. Then we have interest revenue came over at 200, interest expense came over at 2,000. So those numbers are correct. But now let's see. If we compare, we should see that we missed something. Payroll expenses was not included, and that's actually $20,000. Now, I left it this way because it's going to get into some other things that we have to practice as we're preparing our statements. In most instances, a company isn't going to have the selling expenses and general and administrative expenses account. They just won't have those accounts. They are groupings for accounts, but there are various accounts that fit within these groupings. Okay? And what happens is, as the accountants or as the persons assisting with the books, we have to determine which grouping it fits into. In this instance, we're going to assume that payroll expenses is just regular payroll. Like we said, that what happened whether or not we sell the goods or not. So they're not considered a part of selling expenses because they're not directly related to selling the product. So what happens is then that means that my general and administrative expenses should not be $5,000, but it should actually be more. Which is pretty much makes sense because, I mean, for a whole year, you only have $5,000 worth of general and administrative expenses. It's kind of low because, like I said, payroll normally falls under the general and administrative expenses. And so in this instance, there are two ways that you can record something like this. What you can do is you can either add this $5,000 plus the $20,000 by separating it. And when I say separating it, I mean this. Let's insert. Shells down. And we can say, we can have a category that says general administrative expenses. And put general and administrative. And then put payroll expenses and total general and administrative expenses. You could go through the hassle of all of that, and you can just bring these numbers down. Bring this 5,000 here, and for payroll expenses, add the 20,000, and then equals sum of equals this plus this here. You can just take the border away. It might be moving a bit fast, but I just want to show you it like this. So you can either do it in this manner here, trying to make sure everything fits on the screen, Okay, so you can do it like this and have a category for general administrative expenses and just break it out and add it together. I'll put the 25,000, and then in this instance you'd be adding this 5,000 plus the total general administrative, which is 25,000, and it would come down to your 3,200. So you can do that, or what you can do is take away all of that we just did. Take all of that back out, delete, and we can just say 5, so equal the negative sign, 5,000 plus 20,000. Oops. Which is 25,000. We can just add them together, or you can just say, okay, 20,000 plus 5 is 25,000, and put the negative 25,000 in there, and then continue everything else as normal. It achieves the same objective. Okay, and so actually would need this as well if you're doing something like that. We don't need that. Delete. There we go. All of that happens and it's exactly the same. There's nothing lost as a result of doing it this way over the other way. It's just important that the information is correct and that everything balances. Personally, for me, I would just add it together. I wouldn't deduct points for something like that. I would just put the 25,000 in there as long as I know it's included. But for you, what I would say is make sure you're spelling out what makes up that 25,000, because a lot of that is points you're going to get or forfeit because you don't do it. So I would do it like this, but you should make sure you show the detail when it's more than one account that fits in a category. Okay, so yeah, this is just the steps and the process that I went through to move from single step income statement to multi-step income statement. I hope this helps. And there's another example of it in the text that you can look at. So get familiar with it. Get familiar with the different terminologies, understanding what they mean. And yeah, let's just continue moving forward. Let's continue to get it.